Hi, this is Randy Finney with the right side of the chart. This is a mid-session update for Thursday, February 9th, 2023. It's 1:46 p.m. as I'm starting the video. What I'm going to do is start out with the equity markets, brief update there. I think I waited for this point. It's a pretty timely video because we are at that minimum, again, minimum pullback target for the NASDAQ 100, at least via the Qs. And then at time permitting, I'm going to update some of the other recently highlighted trade ideas that I've thrown out. But let's just dive in here and start with the NASDAQ 100. There it is. It's two things, called for in the last week. Called for the market to kind of grind around sideways, but also to work its way down and hit this trend line right there. That was my pullback target. We have a little more downside on NQ. I'm going to get to that in a second. Now, I watch both because sometimes it's the tag of the first one that produces a reaction, sometimes the tag of the second one. But either way, that is a full tag now, perfect, well-defined trend line. And like I said, we've ground around since last Thursday, so it's been exactly a week. And I favor this level going and more downside in the coming days to weeks, whether we get a tradable bounce here or not. My convictions aren't very high, but I'm kind of leaning towards a little more downside here. Again, that's QQQ. There's what it looks like on the daily chart. Let me give you my clean board. That's the busy board. There it is on the daily as well. And then remember, below that, if and when the trend line goes, that's sell signal 1, you have the 200 exponential and the red line right here. Hopefully you can make that out in the video. 200-day exponential moving average, and then down below that you have the or right above that, I'm sorry, the 200-day simple right here in blue. The exponential responds fast to the prices. That's why it's down low. And as I often say, some traders watch one, some watch the other. Therefore, I watch both. But with that being said, we also have the primary downtrend lines. Took a lot of energy to get up and down, up right through those. And so again, I think at best case scenario, we may still continue to grind around in a relative range, and really within that my most likely bounce target zone. That was that red box laid out from all the way back here off this low, and we hit it there. We actually hit the midpoint in the 200-day exponential in the pre-market session there, pulled back, and we're there again. We hit the top of it this time, almost a perfect tag to the top. So that's it. So like I said, best case scenario, I think we flounder around. I don't think this market's going to rocket up and go up another 10% plus without at least consolidating and or pulling back first, a little more than what we've already seen. But I can't make a screaming case to do so. But let me show you the S&P 500 while we're there. This is the primary trend line off the lows on the on SPY, the S&P 500 tracking ETF right there. But I also have on the shorter term time frame, I have two trend lines for you. This one, and I'll show it. It shows better on the 60-minute chart right there, which we've just cracked. So if you want to do this, you can pull this here and count that little wick. But I think the fit that I had before this one is better. Why? Because you have more reactions. You have all these reactions here, a distinct reaction there, a distinct reaction there, multiple reactions recently. So that one just broke down. But again, this is why I look at multiple indexes. At the very same time, a SPY-only trader, someone only trades the S&P, might be shorting the SPY on a breakdown here, not realizing at the very same moment the NASDAQ 100 is at trendline support, where buyers may step in and buy. Okay, and now looking at the NASDAQ 100 futures. This is that 60-minute chart, same uptrend line, but it comes in a little bit lower. Also very, very well defined. There's your low back there, and right around the beginning of the year, right when trading started after the early first of the year, and then multiple clean reaction sets, and we're still a hair above it as well as at 12,456. So I would almost favor a move down there at least to that, and what that can do is punch through the 60-minute chart of QQQ, the 60-minute trend line. This is the way the game is played. So then, therefore, those QQQ traders that are maybe waiting to short a break of that, you get a move down through their inter-period, only to see them ramp it back up and close it on or above the trend line. And that would coincide with a tag of the 60-minute trend line on NQ, where, again, I'd say this off too. Not only do I watch SPY and QQQ, I watch the futures and I watch the ETFs, because there are, again, a big subset of traders that only trade ETFs. Both professionals and amateurs, or retail traders. and those that trade primarily the futures, and therefore you want to watch them both. And like to give it, the safe bet is to see all those levels go. The Nasdaq 100 take out trendline support or comparable support to the S&P. On RTY, you took that out today. I had two trend lines on RTY. These are your small cap futures, Russell 2000. This is a trend line that I think will come into play here. There's only a few reactions off the low, and then this is the steeper, more current trend line that broke today, but you're coming up on pretty darn good price support. So just like the NASDAQ 100 futures, just a hair below. So maybe a good time if you did short the fade the pop last week that I talked about on Friday. These highs right here, Thursday, Friday, and got that, almost 4%, about 4% pullback, or maybe it will be when the Nasdaq hits. Time to maybe take some, for an active trader, to take some profits. As far as how far a bounce may go, I don't think very far. I'd be more inclined to either protect profits on a short if you think we're going to go on down through there, or cover and then maybe reshort either on a bounce off these trend lines or a break, because I do think this, other than there being a grind, and that's again the takeaway here is that active trading mode. Come down, trade the 5-minute charts. That's what I like to do. The 15-minute charts. I showed you the 15-minute last week, and I've given you updates. This is what we're looking at on NQ. That's the same uptrend line that I showed you on the 60, but here's that 15-minute chart I got out to you. And this was a support zone, so you've had multiple opportunities to cover here, cover shorts, and or go long, especially when you see divergences. You had a divergent low right here. That gave us this pop. That gave us right into a divergent high, and it also gave us that trend line. I think I mentioned that to you either here or here recently. I think it was right here that would be a potential bounce target where you could then turn around, sell long, go back short, and it's worked out well. We've had another second opportunity here, so we're kind of respecting this trend line, and it gives us, if you look at the bigger picture, that downtrend line, that very minor near-term downtrend line off last week's highs, and this uptrend line give us a symmetrical triangle pattern. And this is looks like the indexes are building some energy here. Obviously an upside break, especially impulsive and powerful, that should be near-term bullish. So if you take out these highs, and where a downside break is what I favor, even if we get an upside break and a fake out, that would send us quite a bit lower. Let me go over a few of the fangs real quickly, because as I always say, any analysis on the Nasdaq 100 or even the S&P 500 is not complete without looking at the big components, just the big techs. And right here you have Apple. There's Apple. There's Apple's primary uptrend line, very similar to the S&P 500 and Nasdaq. You have these nice clean uptrend lines. Apple recently got rejected off that last reaction high, which was the post-earnings pop from the October 28th earnings. Well, the report was on the 27th after the market closed, so that was the first day of trading, and that's once again what happened there. So boom, boom, second rejection, uptrend line, getting long in the tooth, and let me see if there's anything that stands out on the 60. There's the uptrend line on the 60. Microsoft uptrend line on the 60-minute chart, as well as a daily. I'm going to move this one. You have alternate trend lines here. You have a real tight one there on the 60, and also resistance. And that's the common theme here, is these guys on the glass half full, meaning the bullish case, as I've talked about, a lot of the, if not all the indexes, took out their primary bear market downtrend lines. They took out the 200-day moving averages. But again, that's not unheard of, and it's actually fairly common to pop the 200s in a bear market for a week, maybe no more than 2 weeks, sometimes only a couple days, and then fail back below them. So that's what I'm watching for. And as I've been saying, unless it happens, it's really hard to you can't make a solid bearish case, because you're above those 200s and you're above the trend lines. You fail them, that's a different story, meaning a solid move back below. It's a failure. I know I have busy boards here and maybe clean boards. I'll go to a clean board on Amazon, and this one, look at that, right to that 103-ish, 103.50 resistance level. Tried to spike through their interperiod only to get rejected, and it's been moving lower. So here's another one. Something's going on there. there. Now it's on a daily. That was a 3-day candle. There's that 103.50ish level, and this is a island top reversal pattern. An island top is when you have a candle that gaps up, one sole lonely candle after a pretty nice uptrend, and it's separated by gaps on both sides, and that is a significant topping pattern. That's a topping candlestick pattern consisting of at least those 3 candles. Again, the one there, the gap separates the gap up, and that gap up was smacked down hard right into the intersecting 200 days. So and Amazon so far has been steadily moving lower since, poised right now to make a bearish PPO crossover, as a lot of things are. That's what I've been highlighting there, especially these high level clean 1, 2, every since the bear market started. I just circled the 3 bearish crossovers that it came, but when the PPO was above the 0 line, 1, 2, 3. You know what happened after the last 2. We'll see if there's another repeat, and that means it was the end of bear market rallies, and kicked off the next leg down in the bear market. So certainly possible. And again, some of these key stocks have taken out their bear market downtrend lines in 200s, whereas others have not. And in this case, here's one that had a perfect rejection. And this one's very, obviously, I don't need to say that, very important to the market, both as a mathematical weighting of top component, as well as just the psychological importance. And it kind of is a good pulse for how the economy's doing. If people are buying a bunch of stuff, Amazon should be going up, and if they're not, then Amazon's not going to go up. And I know they have other diverse sources of revenue, but it's again a decent proxy for the retail sector, if you will. Alphabet, that's what I'd call a hard rejection. And there, look, another. And again, this is I'm going to speak a little bit off the cuff here, a little bit of bull fodder, if you will. When these downtrend lines and the 200s get popped like that, it sucks in a lot of new longs, a lot of scares out a lot of shorts. But then when that fails, that's bearish. That's very bearish. And look what happened when Alphabet failed it. A hard rejection, and just been selling off pretty hard since. And yeah, and I know everyone has their own unique things going on right now. I know one of the buzz out there is Alphabet. They've been sitting on their AI for years, even though they were kind of ahead of GPT. And but their worry is that a very smart and intelligent AI model search engine is going to hurt their search engine, which is more mechanical and geared towards showing you things that they want you to buy, and you click and you buy it, and that's where Alphabet makes most of their money. I think over 50% of their revenues come from that. So, anywho, that's it. Maybe not, but it doesn't matter at the end of the day. We can sit here all day long, talk about fundamentals, and you know me, I'll share my thoughts when I have them. But technicals rule the roost, in my opinion. That's first and foremost, and so that's a pretty ugly rejection. And look, we're still above these previous reaction lows, so it's you can't write this stock off yet. Again, it's not an all-in short moment, nor is it an all-in long moment. You still have all the makings of a near-term uptrend, and as long as you reverse above this previous reaction low, that could still be the case. But on the flip side, we're in a bear market, and what you can see here is a rejection off the 200-day moving averages, just like you got hard rejected off the 200 exponential right there. Briefly took out the 200 simple there after dropping below it, and then boom, hard rejection after that. So these are the things I'm watching. Tesla, probably one of my favorite shorts right now. You might say, why, Randy, the stock's bulletproof? Well, again, to say that it is getting overbought would be an understatement. It is extremely overbought. And here's the last time it was this overbought. In fact, it's a little bit more overbought. So from there, you could have shorted it. You never went underwater. It took you a while. You had to be patient. Wait about 2 months. It tested that high two additional times, but then it fell. And the time before that we were overbought was right here. And the time before that was the end of the last bull market, start of the bear market right here. So there it is. I've got an alert going off. Let me check that. 1 second. Okay, here's the alert. The trigger was just caught on the edge of the screen recording. We'll watch this. That's a uptrend line. This is a 6-month chart, 2-hour candles of ZN, the 10-year Treasury notes. So Treasury bonds. So if that goes down much more, that's going to be a breakdown. I'll cover the Treasury bonds in another video. I just covered them recently in another one, so there's no update to be had today other than that. Just want to show you that Tesla has now ran into the 200-day moving average exponential. I will say I don't put as big a weighting because Tesla has traded through that. Well, here it got checked on the 200 simple, went a little bit above it. But again, it's certainly worth noting the 200 simple and exponential are just overhead. Again, very overbought and a hair above that resistance zone. I suspect a momentum fueled overshoot. And then you have trendline resistance not far above. And what I like about it is the 60-minute chart right here. You have a primary uptrend line off the lows, which is a target. I think we're going to hit it. Then you had this little steeper uptrend line. You know, this one's gone sort of parabolic. When you have an uptrend, then you start increasing the slope. That's a parabolic move. And but when you look at it this way and you break it down into shorter term, you have that short-term trend line there. And you had, as I pointed out last week, negative divergence. You broke down. There was a sell signal. And when these wedge-type patterns break, that's an objective short entry. Sometimes you go straight down, and sometimes you go in a back test. And that's what this is. This is a back test of that wedge right about the apex. And so with some of the other big fangs, big techs starting to roll over, this one has I think a big game of catch up to play. So measure it out. Bare minimum would be a move down to that trend line there, and that's 13%. And easily I could see us coming down here, and that's about a 20% drop. So I like that one. Alrighty. NVIDIA, waiting for that trend line break. NVIDIA and the semis just highlighted. I'm starting to scale into those. Started to yesterday as for shorts. SOXX right here. Yesterday or the day before. SOXX right here, waiting for that trend line to break to add to that position. PPO is poised to make a bearish crossover right now. Look at that, any more downside, and it looks imminent to me. You know, it's no guarantee. Sometimes you start to roll over. Look, sometimes you go, you kiss, it bounced last minute, but come on. I mean, this, you know, I've been doing this long enough. When you see the PPO peak out like this, the RSI overbought, it's a matter of time. So I like this one as a short, one of my favorite short sectors, as I highlighted yesterday for you. I think it was yesterday, along with what was it? PSP, private equity ETF. This one's interesting because what I'm going to do is pull up a watch list for you. Let's see if I can do that. I have to float one. Well, I can just tell you, I have a watch list on another screen, and this one populates automatically. This is from TC2000. They do a good but not perfect job of showing you all the components, and I can tell you right now, out of 25 stocks in there that they're showing, every one of them, all 25, I'm sorry, 23 of the 25 are red, and they're down pretty substantially. On average, it looks to be just eyeballing about 1%. Here, you know what I can do? I think I can move this over. 1 second. Here, let's see if I can drag that. Yeah, now you can see it. Okay, there's my watch list right there. Look at them, all red, most down, 1.5%, 2%. Two of the top ones right there, and those that are up are barely up. This one's flat, 0.01% IAC, and then 0.07%. So why is this little bugger up, green? Well, I pulled the holdings. I went to the company's website, the ETF company, and this seems, for whatever reason, this is their largest component. This is a thinly traded TGOPY 3I group, and that's the only thing, because of the weighting. It has a bigger weighting keeping it up. So I just want to say one single stock has turned the ETF green. But with that being said, it's just like the stock market. It's breadth. The breadth in this sector is horrible right now, and it's just one stock holding up. Same thing where I've highlighted many tops in the market in recent decades, the last couple decades, where you see the stock indexes continuing to go up, and more stocks are falling below their 200-day moving averages, 50-day. fewer and fewer participating in the rally, and it's just your big five: Amazon, Microsoft, Alphabet, and in the past Meta. And so you're seeing that here. You're seeing deterioration in this sector, and so I just wanted to reiterate my this is one of my favorites, but a little bit of work to be done. And again, the ETF is PSP. Not the most actively traded one. It's a little obscure. I've never traded this one before, but I tried to find, which I did, an ETF if you're interested in shorting it. And like anything, it's one of many. It's part of a diversified portfolio with longs and shorts, commodities, stocks, different sectors. And like anything, it plays out or it doesn't. But it's still, still on a sell signal. It's below the wedge, broke down, and it's still an objective short entry, and still like that one. And then BX, this is the second largest holding, Blackstone. Look at that. Bearish PPO crossover in the works right now. Looks like it's just crossing over today. That's the last time we had one high level. Time before that was right there. This is wash, rinse, repeat. And again, there are no guarantees. I would much rather lose money on this trade and be wrong on this trade than not take it. When I see, it's clear, and these are every one of the high level bearish PPO crossovers since the bear market started. I don't think I missed a single one. All those above the zero line, and you can see what happened each and every time. So it either works or it doesn't, but I put the odds in my favor, and that's why I'm short this. Think we're going to get another leg down here in the private equity sector. Okay, I told you I'd cover a few more. Gold, GDX, playing out, couldn't play out any better. There's the breakdown, sell signal, the back test if you missed it. Those were two objective short entries. T1 was this yellow line. We hit T1 as expected. We had a reaction, and it didn't go very far as expected as well. We bounced back up to that $31. That's that resistance level there. Went in this little trading range for the last last week, and then boom. So this often happens after had that initial consolidation. That's a reaction. I define a reaction as when you're going down and you hit a support level is either a bounce and or a consolidation. Sideways. It was a little both. You definitely bounced, but not much. And boom, now T1, that 3009 level has been taken out. That triggers the next objective short entry or add-on, especially if you recycled back in, you gain the bounce. And that should open the door to T2, which is 2850 right there. And of course, gold and silver will go down along with the miners are going to follow the metals. Silver hit that 2060 first target, consolidated around it, mostly on the underside, took it out. Actually, hit it that first day and bounced down below it, up against it, I should say. And probably going to head down here at least at 1982, and then GLD, gold. Of course, gold, reason for shorting the miners. Sell signal very clear. Sell signal there on that break of that trend line. Gap down the next day, kind of flagging, consolidating here, and we'll probably get one more thrust down soon. And part of that also had a lot to do with the euro US dollar, which broke down. That put in a divergent high here, then gave us a sell signal on the break of the uptrend line / bearish rising wedge pattern, and then took out that 107,633 support. We're just below it now, and that is support. Once broken, becomes resistance. So this one should, I suspect, most likely come on down and hit that swing target, which is this uptrend line off the low there. That's what it looks like on the daily. And on the 60-minute right here, there's that resistance, same resistance, and there was that little wedge right here. Remember, we did put in after the top, we had a sharp move down, biggest drop in the euro in a while, and biggest drop in the euro US dollar pair, and put in a little wedge there, and that little wedge with that divergence played out for this little counter trend bounce, but that's probably it. And most likely coming up on the next leg down. And then old Mr. VIX, going back to the stock market, pushing on that 20-ish resistance level. That's a 60-minute chart. This is what the daily chart looks like. The purple lines show you the big bullish falling wedge complete with positive divergence. And so again, this is what, and I've talked about the consolidation in the market. We've got that. We've had a week of that. But remember, if the VIX breaks out, the VIX can really run once it takes out downtrend lines. So that would also coincide with a pretty sharp leg down in the market. So just because I said we could see some more consolidation, and again, that was my best case scenario, that the market is pretty much going to stall out and may not go down hard right away, but it probably won't go up much either. In other words, the next 10% will likely be to the downside. But if this VIX, if it pops, and it's trying to right now, that's this chart's delayed. Let me give you the real one. I don't know why TC2000 delays it. I have other charting programs I use. Let me give you the VIX. Got it down here somewhere. Here we go. This is that 120-minute chart right here. This is real time. Downtrend line, positive divergence. Same thing that I showed you on the daily of the VIX. And it's trying to pop that level. It's not clearly in the rearview mirror. Sometimes you get some spikes, but you know, the VIX may want to run if it takes that out. And now, again, here's the thing. This is far from mere coincidence that the VIX is testing a primary downtrend line poised to break out at the very same moment that the S&P 500 and the NASDAQ, particularly the NASDAQ 100, which is what this rally is all about. It's what the bear market's been about. It's what the last bull market was all about. I'm talking about big tech. They led the market up. They were the leaders throughout. And then when the bear market started, they 110% were the primary cause of the bear market, as predicted. You know, they had the most bearish charts. They went down. The Dow, the S&P outperformed on a relative basis quite well. You know, the steady Eddie non-tech stocks, you know, held up relatively well. So, you know, the market's all about the big tech. And again, it's the simple weighting. So going back to that, my point was that you have the stock market testing a primary uptrend line at the same point that the VIX is testing a primary downtrend line. So it's certainly possible to see a fairly explosive move coming out of there if the indexes break down and the VIX breaks out, and those breakouts are anything but, you know, could be a whipsaw. And you know, I can't promise you if it's going to be or not. All I can tell you is that I still think the RR for a swing or trend trader, you know, I'm not talking today, tomorrow. Today, right now, yeah, I already told you, bearish. Near-term trend's bearish, and it's a little more downside to that uptrend line on NQ. But if those go, then I still think the in the coming weeks, we may continue to grind around, but it'll most likely, if it's just a grind, it'll be a grind to the downside, I believe. But let's take it one step at a time. Let's watch those trend lines. There it is. We're coming right up to the uptrend lines on NQ. There it is, 60-minute uptrend line. Also price support just below. So good time for an active trader, in my opinion, to either hard cover your shorts if you shorted last week at the highs, or lower stops if you think we're going to go on and cut right through there and break out. I suspect buyers will step in at least once more. That's what they'll probably do, and the VIX will, even if it briefly pops that trend line, will probably come back in. But if you start to see everything just go down and one support level after another gets cut on the market and the VIX starts to roar, hey, this could be that moment that no one's expecting. And that's the thing about the stock market. It's kind of like, always keep your guard up. You never know when these things are going to come, especially the big moves. They tend to come out of nowhere, where the least expected. When everyone's expecting a big move up or a big move down, and everyone's positioned for it, it usually doesn't happen. So just keep that in mind. All right, let me just get the video out to you guys. There's some other trade ideas out there, plenty. I've been going through all the stocks in the S&P 500. I'm looking at different setups, many things that I've already covered in the past. I'm trying to go from memory now. Let's see if I wrote some of them down. No, I didn't. I flagged them in my watch list under the S&P, so I'm going to have to call that list down and give you a short list of individual names in addition to what I've already given you. And the only other trade, I don't know if there's any more interest, if everybody's given up on it. Natural gas still hanging in there. PPO, let's see if we get that crossover yet. It's yeah, green today, but remember, it's looking like yesterday was flat. You can't even see it was zero. So today's the first day. If it can close that, it's not the end of the world. It's not like a hard buy. It must rocket, but it is. It's a buy signal if we get that. And then if we get into even bigger green one tomorrow, that's all the better. Because as of now, remember, this was a buy signal the other day. We broke out of that long-awaited downtrend line, very, very clean. Broke out. Sometimes, like I said, sometimes you run after breakout. Sometimes you backtest and then run. And sometimes you break out and fail. So that's it. You shouldn't fail. If it does, it's not good. But also, as I've already covered, and I don't have that chart queued up, on the long-term chart of natural gas, going back years, the 250-ish area is big, big support. So personally, I'm going to just keep rolling natural gas futures as long as they're in that range, give or take. No reason not to, because it's a commodity. And, we're in an inflationary environment still. It's abated a little bit. And, commodities are about the one thing that you don't have any risk of them filing for bankruptcy protection. They're always going to be around. They're always going to be in demand. And with natural gas prices as low as they have been with this big drop, I can promise you there are a lot of power plants that have been switching over from coal and the other sources and buying that natural gas on the cheap right now to fire those plants. And so you're going to see seasonality. Yeah, well, we're heading into the warm season. Winter's out of the way, but again, how much of that's been priced in? So anyways, maybe it's dead money for a while, but I'll still maintain these targets as of now. All right, so that's it, guys. Short equities, short semis, short certain sectors. Those sell signals on bonds today may pan out. I'll have to revisit that, but let's just see what happens with these trend lines right now as we are testing on the Nasdaq 100 and the VIX. Keep an eye on those two things, and then just get ready to engage if that's your thing and you think we're going to take a sharp leg down, which is certainly a possibility. So I'm going to wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.